So I'll be talking about the highs and the lows. Now, this is a very key concept that you all need to understand. I'm sure you're familiar with swing highs, swing lows. If price is in an uptrend and then it retraces and makes a new high, retraces, make a new high, retraces, right? That is our swing low. This is our swing low, and this is our swing high, and this is our swing high, and this is a swing low, swing high. Perhaps this would be a swing low if price goes higher from there. All right, so that is the idea. That is the idea. This is our high, this is our low, this is our highs and lows, highs, lows. Just think of it as being of price being in a rectangular box, right? Whenever you come to the screen, there is a high, there is a low, and if there isn't, just wait for it. Wait for it. If price, let's say, has been trending and trending, now you have your box, right? Or say maybe price has made a new high, right? Let's say you can't see any high on the left hand side, and you're like, where is my box? Just wait for your box to form and give it 1, 2, 3 hours. You see price would eventually retrace. Price would eventually give you your box. And that's the concept. That's the key. That's the concept. Just a swing high, swing low, rectangular box. Look for it. And I'll show you live examples. So we've got price action here. This is the chart. This is gold. We see price making high highs, high lows, high highs, high lows. Now where is my box, right? If you look all the way from here, you would see that price, this was a swing low. This is our first box, okay? Price went higher, give us another box, another high. Price eventually broke this high, give us another swing high over here. Came down, retraced down, gave us another low over here, right? Price eventually broke above this high, giving us a peak formation, right? And then another low here. Price came back, took out that low, right? Giving us another new low. Price went higher, give us a swing high, right? Came down, give us a swing low over here. This is another swing low. And here we are. If we keep going forward, you see price made another high, and we can just keep going, right? That is our highs, and this is our lows, our highs and the lows, highs and the lows, and highs and lows all the way, and you can keep going. So say you're here at this point and you're wondering, where's my highs and where's my lows? Okay, we see price made a high here. Price took out the high, right? Now you have your highs. Price broke the high and there is no high in place. Just wait. Just wait. Eventually, price would make a high. Price would retrace. Price doesn't just go up in a straight line. Price would eventually pull back, right? Giving you a high, a new high in focus, right? So that's basically the concept. And why is this key, right? Because when there is a high and when there is a low, it means there are stop losses below that highs and lows. There are money sitting there, right? There are money sitting there. There are money sitting up here. There are money sitting up here. There are money sitting down here. Money, 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 money. And what do I mean by that? Stop losses. Stop losses. So anyone up here looking to buy, where are they placing their stop losses? Their stop losses are getting placed below this low. Anyone that decided to sell anywhere down here, whatever time frame, where is their stop losses? The stop losses are being placed at the high. That's key. So that's why you need to understand and identify your highs and lows. Okay? And that's why this concept is key. You need to be able to identify, what box you're in. Whenever you come to the screen, what box am I in? Some people, they go down to the 15 minutes chart and they draw their highs and lows on the 15 minutes chart. Obviously, by doing that, you'll get more trades. Basically, the higher the time frame you go, the more volumes are sitting above the highs and the lows. Make sense? So now when you have a 1 hour high in this case, a 1 hour high here, and a 4 hour consolidation. Now this is a 4 hour high as well, because price consolidated for multiple hours. So this is a 4 hour high. So once price pierces above this high, there is significant volume sitting above that high, right? Because it's a higher time frame high. Likewise, the lows as well. Again, it's personal preference. You can go on the 15 minutes, 1 hour, 4 hour. A high is a high, a low is a low. Okay? And that's key. Another important concept that you need to understand is the high of the day and the low of the day. Now, if you're just looking at the 1 hour highs and lows, you probably don't need to worry about that, because the low of the day, it's going to be a low on the 1 hour. A high of the day, it's going to be a high on the 1 hour. Okay? Or the high of the previous day would be the high on the 1 hour. The low of the previous day would be a low on the 1 hour chart as well. So personally, I would say stick to the 1 hour chart. You can get those clusters of volume on the 1 hour chart. It gives you better opportunities, or say more accurate opportunities. Okay, so again, low here in place, and you would understand why this is important in subsequent sections, but this is key. Understand how to draw your highs, understand how to draw your lows. It's very easy. The key point here is I want to make sure the price has consolidated, okay, for at least 3 hours, 3 to 4 hours, all right, at the minimum. So if there's a high or low in place, I want to make sure that that high or low has been in place for more than 3 hours, okay, before I consider it as a high or a low, okay. And once I have that high or low identified, then I wait for price to come back at a timing window to hit those highs or lows before we then look for our trade. Okay, so what do I mean by that? Let me show you. Okay, we have a high in place over here. Price formed the high 1, 2, 3 hours. This is the 1 hour chart. All right, so price has stayed below this high for more than 3 hours, okay, before going to test it. So if this was our timing window, it would be a trade we might consider, okay, because it's a high that's been in place for more than 3 hours. Okay, all right, so this is just to show you how to identify your highs or lows. It doesn't mean all these highs or lows are trades that we're going to consider. All right, I'm just showing you the concept. You can go ahead and build something based on these ideas, but the idea is we're trying to identify our highs or lows. For us, it's going to be the previous day's highs or lows, but really any highs or lows, you'll find that when price hits it, especially in those timing windows, you will find some sort of reversal. It could be 25, it could be 50 pips, it could be 100 pips. You don't know how far the retracement will go. Okay, so we have a high in place over here, price hits it, all right, we traced. We also have a low down here. Has that low been in place for more than 3 hours? Yes, it has. Price formed the low 1, 2, 3. It's a valid low. Price hits the low in this case, and then went higher. First hour, second hour, third hour. So price has not broken this low in 3 hours. So we're going to consider it as a low. Now we're going to sit and wait for price to come back to this level. So now we have a high. So we have a high in place over here. All right, this high has been in place for multiple hours, more than 3 hours. Price proceeded to hit the high and then consolidated, move sideways. Okay, trapping traders in this box, this 50 pip box. See this round number 50 and 0 before price continues its uptrend. Went sideways for a long time before retracing. All right, but now we have a high in place over here. We have a high in place, first hour, second hour, third hour. That high was then broken. So this was a trade we would have considered if we're looking to take a trade. All right, so we have a high in place over here. Okay, we're gonna draw this high. It's been in place for 1, 2, 3. All right, so it's a valid high. So we see price begins to retrace from that point. All right, and then price came back to test the high. All right, price came back to test the high in a timing window in Asia. This high has been in place for more than 3 hours, so it's a high that we would consider. All right, so now we have a low in place over here. Okay, price came down to test the low. It's been in place for multiple hours, so it's a low we would consider. Price proceeded to auction higher. Okay, price proceeded to auction higher. Now we have a high in place right here. Price hits the high. It's been in place for more than 3 hours. Okay, so now we wait. Price stop onto the high and then retrace. No, now we have a new high. We have a new high in place. Has it been in place for more than 3 hours? So price forms the high. 1, 2, 3. The third hour broke it. So this is not a high we would consider. Then we just draw a new high in this case. And then we just keep repeating the process over and over again. But the key thing here for you to understand is we want to make sure that the high or low that we're drawing, it's been in place for multiple hours, at the very least 3 hours. Okay, so once we have that cluster volume, for 3 to 4 hours, and then price comes back to hit the highs or the lows, okay, at the start of the session, the first, second hour, or third hour of the session, you will find that price is more likely to retrace at that time. Okay, so the key concept here is you want to identify our highs or lows. And what's that? It's a high or low that has been in place for multiple hours. Okay, 3 hours minimum. All right, and then once we have that high identified, then of course we just sit and wait for price to come back to hit it. Okay, quick recap. We want to identify our highs or our lows. Okay, because that's where all the stops are sitting, above the high, below the low. All right, everyone is placing their stop loss there. All right, so once we have that identified, all right, we have a low in place over here. So once we have that identified, we just sit and wait for price to come back to hit these levels in our timing window. All right, we'll just sit and we'll wait for price to hit this level. The reality is price would react at many of these highs or lows, but the highs or lows that we're looking at is specifically the previous day's highs or lows, because the idea is we want to trade less, and by trading less we want to identify the most probability way of trading that would reduce the number of trades that we'll take, at the same time increasing the probability of our trade being a success. Okay, so even though many of those highs are highs, if you go down to the lower time frame, 15 minutes, 5 minutes, in fact the 1 minute, you will find highs, there are many highs. All right, price will reverse, price will react to many of these highs, but that's not our concern. We're just waiting for the high probability setups, and for us it's going to be setups that's coming from the previous day's highs or lows. All right, the previous day's highs or lows. It is exactly the same idea. Okay, so in this case, all right, this was the previous day's high. All right, this would be the high that we would be considering. All right, this is the previous day's high, so it's the high we're going to consider. All right, and then where's the previous day's low? This is the previous day's low over here, and that's the low we're going to consider. So every day we're just going to sit and we wait for price to hit one of these extremes. Okay, this highest point, lowest point, and how price behave when it gets there tells us whether it's a trade we should take. Okay, so you can see how price took traders lower before going higher aggressively. Okay, we want to see the opposite of that. We want to see price take traders higher. Okay, like in the creeping trend to the high before we look to take the reversal. Like in this case, if this trade has continued downwards to the low of the day, that is the trade we want to take, because you can see price is beginning to trap traders lower. Whenever a trader come into the screen at this point, they are selling at the low. Okay, this is the high over here. They are forced to sell at the low. All right, so price is trapping them lower. Okay, once you start to sell at these lows, you're opening yourself up for a stop hunt, because price could easily just reverse and take all these orders. Okay, price is creating all these order flows, and price could just easily reverse to take it out. So that's why we're looking to trade on the outside of this box. Okay, we want price to take traders lower. Okay, and then we enter the trade. Okay, at the low, knowing that there is a lot of volume that took traders lower. Knowing that there are a lot of volume, seeing that this trade went lower, a lot of selling volume. Okay, so when this trade decide to reverse, all right, all the stop losses are going to act as fuel to push this trade very strongly in our direction. Okay, so we want to see price taking traders lower or higher, all right, above or below the previous day's high for us to do anything. But the concept is the same. We want to identify our highs or our lows, all right, okay, and then we wait for price to hit those levels, and we look to enter our trade. This is an example of price hitting the previous day's high. All right, price hitting the previous day's high in our window before reversing. This is the kind of trade that we're looking for, price taking traders higher. You can see it's completely different from this example where price took traders lower first before hitting the high. We want to see the opposite of that. We want to see price take traders higher, all right, hitting the stops, all right, at the highs before reversing. This high has been in place for more than 3 hours, multiple hours, so of course it's a high that we would consider. All right, I'm not saying all of these are trades we're going to take, but the idea is simple. We want to identify our highs or lows, and then we sit and we wait for price to hit those levels before we do anything. I hope that makes sense, guys. All right, understand this concept, understand how to draw your highs or lows. It's very basic. It's pretty much the swing highs, swing lows. We just want to make sure that, you know, these highs or lows have been in place for more than 3 hours, 3 to 4 hours. Okay, and then we sit and wait for price to hit it before we decide to do anything. Okay, and I can show you on the 15 minutes time frame briefly, you know, just to see how this behaves, and to tell you and show you that, you know, it doesn't really matter, you know, whether it's the previous day's highs or lows. When price hits the highs or lows in a timing window, you tend to see a reversal. Okay, you see a high in place, price hits it in a window, reversed, price came back down to the low, hits it again, and then reversed. Likewise, we have a low in place, price hits it, reversed, went higher, hits it again, and then reversed. And there are many traders that want to trade the breakouts, you know, and they're setting their buy orders, their buy stops, their buy limit orders, price, you know, take them in and immediately put them in a losing position. All right, that's where we want to be selling. We want to be selling high. We don't want to be, you know, buying high. Okay, price took traders higher, took traders higher again before coming back down to hit stops. All right, we have a low in place here, price hit stops before reversing, and on we go. You see, every day, every session, price is looking to hit stops before reversing. All right, okay, there's another example. Price took traders higher, hit stops, came back down to the low of the day, hit stops before reversing. I hope that makes sense, guys. We're always looking to trade the reversal. We're looking to identify our highs or lows. Make sure
making sure that the highs or lows have been in place for multiple hours before we look to enter the trade. And the idea is, the reason we're doing that is, once it's been in place for that long, there's a lot of cluster volume sitting at those levels, that when price hits it for the first time in our window, we would see a reversal. Okay, I hope that makes sense, guys. All right, you understand more as we explore other concepts in subsequent section.
All right, see you in the next section.